Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. You can get our free book and more educational resources at nextlevelincome.com. On today's show, we have Kris Benson, who's Chief Investment Officer with Reliant Investments. Reliant Investments is a vertically integrated commercial self-storage operator located in Roswell, Georgia. Mr. Benson oversees the equity raising arm of the business. He sits on the investment committee and manages investor relations. In the past 24 months, the Reliant team has been responsible for over $200 million in self-storage acquisitions across the southeastern United States. Kris was a sales professional. He brings a wealth of knowledge from his ownership experience in the commercial multifamily arena. And prior to joining Reliant, he worked for Intuitive Surgical, also another medical device company, which was the developer of the Da Vinci surgical robot. Mr. Benson graduated from the State University of Binghamton, and he currently lives with his wife and children in Roswell, Georgia. So Kris, welcome to the show.
Good morning, guys. Thanks for having me.
Absolutely. So Kris, I know your partner Lou, who lives not far from me here, which is how we met. He connected us. But for the audience who's listening today, please share your story about how you went from being in New York in the medical device field to being down south here with us and entering the self-storage investment industry.
Sure, I'd be happy to. So from my background's pretty varied. To your point, Kris, I came from the medical device industry previous to going to real estate full time. So my background was sales, and essentially when I turned, I don't know the exact date, but somewhere in the 30 range, 28 to 30, I distinctly remember waking up and saying to myself that I can't do this for the next 30 years. So I was very successful and I guess in the metrics that you traditionally measure. I had a great job, worked for great companies, had a really nice career, but the biggest issue was time. I just didn't control my own time. And I think the bigger thing as I got older and realized was I never was going to. I was on a path that just kind of started over every January 1st. Quotas just start over and away we go again. So what my perspective was I got to find something to replace that income, and preferably in a passive manner. And so that's what led me to real estate investing initially. And I started on a path similar to probably how most everybody has. So we initially bought some duplexes in the town that we lived in upstate New York. And we bought a number of those units and very quickly realized that was not scalable. It was awful, actually. It was my least favorite part of the real estate endeavors that I've been a part of. And mostly it was because not necessarily the day-to-day management aspect. We had outsourced that pretty well, but it was really the people part of it. We were managing B minus type properties, and it was almost soul sucking. It just wasn't what I wanted to do with my extra time, which was very limited already. So we got into commercial multifamily. Actually, my first multifamily project was a 64-unit development. We ended up selling all of the duplexes we had, and I had a family friend who was a construction developer guy in the town I grew up in, and I randomly called him one day. I hadn't talked to him in probably 15 years and said, "Hey, I have a little bit of money. I want to get into apartments. What do you got?" And he had just so happened to talk to a municipality about a piece of land that they wanted to do something on as far as housing. And that led to a discussion of building the 64-unit complex. So fortunately, I have a wife who's very risk tolerant because essentially we just put our life savings into this project, and wow. Had a great partner who kept us safe for the most part. I mean, we had little hiccups here and there and still do, but that was the beginning of commercial real estate for me. And so, Kris, for me, there was a quote that I heard or read, and I wish I could give credit to who said it, but it was big deals and small deals are the same amount of work. You just make less money in small deals. And so that was really true with commercial real estate. Is once I understood kind of the scale that you could operate on, the light bulbs went off. So from there, I started investing passively into some syndications around the country, primarily in primary markets, Dallas, Atlanta, Phoenix. And essentially what we did was my little group grew organically. So people knew what I was doing and said, hey, I'd be interested in investing in the next project that you're a part of. And pretty soon that group was sizable, where we were able to bring pretty large equity checks. And in return for that, I was earning ownership on the back end of projects that I was investing in personally. So that's how I got started kind of investing on the commercial side of things. And then I know this is a long drawn out story, but it's basically my life. So I feel like I at least get a few minutes to talk about it.
Absolutely.
But how we got to self-storage was as an asset class of multifamilies cap rates have continued to compress. I wanted to see what other types of asset classes still had value. And in doing some homework, self-storage was one of those. And I ended up talking with a number of self-storage operators, Reliant being one of them, where I am now. And I started out as an investor in Reliant first, and then kind of fell in love with the platform, but more importantly, the team who was here. And as a function of that, about 2 years ago, Todd, my partner, essentially said he needed help in raising some equity. And he described what he was doing at that point. And I said, well, we can do better than that. And we formed a partnership. I joined the company as an employee. It'll be 2 years in April. And it's been pretty fun. We've relocated our family to Georgia. This summer we moved down to Roswell, where our office is. We're just outside of Atlanta. And it's been quite an adventure.
I love it. Thanks for sharing all that, Kris. And one of the things I think that I enjoyed when we first met was a lot of the similarities that we have in our stories. So what year was it that you did that development? I'm just curious, kind of going back through the cycle here.
I think we did it in phases, in 16 unit phases. So I want to say 2013 is when we started it. And then built out a 16 unit phase at a time. The first one we did 16, the next one we did 32, and the last one we did 16. Gotcha. With the idea of the market we were building in was a tertiary market by all means. And so the hypothesis was essentially, we thought we could be essentially the only Class A apartment offering in the market. And so our rates comparatively, compared to the comps, were way above what a 2-bedroom, 2-bath would be in the market. And so we wanted to see if there was a market for these types of assets. And, it was my partner's hypothesis more than mine, but I went along for the ride and it turned out pretty well.
Terrific. Awesome.
You mentioned cap rate compression as being one of the reasons that you first started shifting your focus to self-storage. So for someone listening, though, who might not know much about investing in self-storage, could you dive a little deeper into why you invest in self-storage and now have, you're made a whole career shift to that area?
Yeah, I mean, if you're aware of what's happening in multifamily, there's just so much capital chasing deals that, and this has been the case for probably the last 3 years, that cap rates continue to compress. So it's harder to find value. Storage will get there, and we've certainly seen a cap rate compression. I don't know if it's necessarily as much as we've seen in multifamily, but when I looked at storage, there were 3 things, Caleb. I'm a data guy. I like to see kind of the historical data and understand where that's going to point us for the future. So for me, I looked at a couple things. One was returns, right? I mean, everybody wants to talk about historical returns, and the database I like to look at is the National Association of REIT data. It's the NAREIT. You guys can put this in the show notes. It's free, and
that's terrific.
Everybody has access to it. But they have 25 years of all the publicly traded REITs, and you can look at every subsector of real estate. I mean, to the timber, agriculture REITs, if there is a publicly traded REIT, they're tracking it. Storage in the last 25 years did just under 17% a year. And even comparatively to apartments, which I think was around 13%, it outperformed. So that was kind of an eye-opener for me. And storage has always been considered, well, maybe until now, the secret's kind of out, but it's kind of this niche-y thing where, apartments, office, retail are kind of the darlings of commercial real estate, and storage has always been, this redheaded stepchild that all of a sudden people said, oh, that does really well. Let's get involved. And the other thing that I looked at is, so, performance was really good. And then I wanted to understand what happened in the last correction. So if you look at data from 2007, 8, and 9, storage lost less than 4% of its value at the REIT level. And if you look at what happened to apartments, it was closer to 7 or 8. And then retail and office just they got hurt, as you'd expect. Yeah. And S&P 500 during that same time period was down 22+%, right? So not only did it perform well historically, but had some downside protection. So, two things, check the boxes. That seems like a pretty good asset class to get involved in. And then lastly, and this is probably the reason, Caleb, I've hitched my wagon to storage, for lack of a better term, is really the consolidation opportunity that exists in the space, right? So, there's 5 publicly traded REITs in self-storage. The names that, if your listeners are listening in a car, if you look off any highway interchange, you're probably going to see, Extra Space, Public Storage, CubeSmart, and there's 2 more. And U-Haul is one of the 6 publicly traded companies, not a REIT. But those guys own about 25 to 30% of the market, depending on what data you look at, right? So the other 70%, the ownership is very fragmented. So I see that as a consolidation opportunity, right? Where in multifamily, those properties have been consolidated for the most part. I mean, there's still, as you guys know, there's still opportunities out there, but it's much more challenging to find. Here, there are still, in self-storage, there are still a lot of mom and pop operators, think people who own 1 or 2 facilities, that offer tremendous opportunities for growth and value add. So that was really the 3 reasons that brought me to storage initially. And at Reliant, we're doing a little bit of everything. We're not doing just value add. We're doing stabilized assets and development. So my partners and the team here have a vast knowledge of storage, and so they're able to apply that across the board.
Terrific. So Kris, you talked about some of the data that was in there. What are the similarities to multifamily or differences that you see? Like we look at the baby boomer trends, the millennial trends. People are if they're downsizing, I imagine they're putting their stuff into self-storage, for instance. If they're millennial that's moving from city to city, they're more transient than prior generations and mobile with their careers. How does that affect what you guys do?
Yeah, I mean, we're looking at this similar demographic trends that multifamily asset classes too, right? Job growth, population of a market, yep. Traffic count, the amount of supply in a 1-3-5 mile radius. I mean, what's interesting about storage is the demand is challenging to understand. So, I think from a perspective of how do we decide who's going to move into a storage facility, that's one of the biggest challenges that we see at an underwriting level. I think as an asset class itself, we're a business of change. So anytime there's transition, that's usually good news for storage. You just mentioned, Kris, moving, right? I mean, if people are moving, typically their stuff's coming in and out of storage. What's been interesting is if you look at the percentage of the American population who's used storage over the last 10 years, it's a hockey stick graph.
Yeah.
What we don't know is why. Right. It's sort of been, if you build it, they will come mentality, right? Where what's happening to influence how storage demand is getting consumed or how storage is getting consumed. At least we don't know. And I would argue that most of the operators in the industry aren't 100% sure of, hey, how do we ascertain demand? There's been some interesting studies where people have spent a lot of money trying to understand statistically significant metrics that matter to demand, like things very nuanced, like divorce rates in a 5-mile radius, right? Move-in rates, new jobs, and none of them are statistically significant. So each market's very nuanced. And the one thing I'd say about storage, Kris, different than apartments, is it's a sharpshooter's game. So, our tenants are usually 70+% of them come within a 5-mile radius. And so all that matters is that
Yep.
MSA, right? That 5-mile MSA.
Yep.
The data at the market level is somewhat irrelevant. It's about understanding that intimate group and what's happening in that particular radius of from your store. And I think that gives you the opportunity to go find, maybe markets that have been traditionally oversupplied, an opportunity to go out and find something or a good opportunity in that space.
Yeah, and I've noticed on your website, I mean, if anybody goes and checks it out, you guys, you follow, similar demographic trends to where what we look at, Southeast, you guys are heavily concentrated there. What geographic areas are you guys focusing on in the future?
So we're vertically integrated, right? So we're the management company as well as the acquisitions team. So we have 50, as of today, 57 properties in the portfolio. And so we're always trying to connect the dots on that portfolio, right? If you think about how we exit or how we look to exit, it makes sense, or there's a better valuation if we're able to exit at a portfolio level. So we're trying to connect the dots with the portfolio we currently have. And not to say that we won't look in states that we've never been in. We just bought our first 3 properties in Tennessee this summer. We probably wouldn't have done that if we bought one, but the ability to have 3 and create some scale. We have a portfolio in Alabama, so we're trying to connect it with the Alabama portfolio. I think that's how we look at it. We're opportunistic as far as markets are concerned. We like the Southeast, for the reasons most people do, net population migration. You got a lot of people moving from the Northeast to the Southeast. So you got good population growth.
Like you.
Like me, indeed. And then, obviously there's some tax advantages. Florida doesn't have state income tax. Tennessee doesn't have state income tax. So, there's definitely some reasons why people are moving here, as well as the weather. So that we kind of look at anything, but essentially our first blush at it from an underwriting standpoint is going to be, does it match with the rest of the portfolio? Is there a reason we'd like to be there?
Terrific.
Chris, before you had mentioned briefly a couple different strategies like value add and stabilized assets. Could you explore a little bit about the different strategies you all take with the assets you acquire and how you apply them?
It's not too dissimilar, Caleb, than any other asset class, right? So, a core plus or a stabilized asset, essentially we're buying it to clip coupons, right? We're buying it for cash flow. There may be some things that we can add to improve, but for the most part, we're buying it for the cash flow. It's a low execution risk strategy. A value add deal, the business plan on our value add properties are different for each one. And I think, Todd Allen, who's one of the co-founders of Reliant, his advantage is he's got a vision when he walks on the property of what he wants it to be. And so, a value add for us could be, we go into a market and the current owner has an expansion opportunity and we feel like the market's undersupplied. So we're going to put a shovel in the ground and build out some buildings. And we do that quite often. We have an internal project management team. We're not the GCs, but we have an internal construction project management team that's managing those process for us. The value add also could be, like a C of O deal where we're buying an asset at certificate of occupancy and the value add or the risk is getting it leased up, take it from 0 to stabilized, and implementing our management strategies to do that. So really value add is a pretty broad definition for us. It depends on the particular property and where we think the opportunity is. Development deal, Caleb, is what you'd expect development to be. We buy a piece of dirt, get it entitled and permitted, and then we're building out a building and, most risky on the risk spectrum. I typically know cash flow for 2 years and, investors on the development side are really hoping for the back end pop. And at this point in the cycle, we're really hesitant for ground up, but unless it's a real home run.
Kris, so what are you seeing in terms of, you're talking about, when you're leasing up or you have stabilized, what are you seeing in the market in terms of self-storage, how technology is playing in, and like what different amenities? Obviously, in apartments, you have different amenities at C, B, and A levels. Residents are expecting different things. Are you seeing the same thing in self-storage?
No, we rent boxes. It's hard to put amenities in a garage. I mean, look, so there's definitely an A, B, and C class level. Okay. It's not quite the same categorization and as cleanly as defined as apartments are, but what most tenants want is safe, clean, reliable, right? So expect to walk into a retail location that looks like a retail center, right? Storage has come a long way. The first storage unit I ever rented was a guy's house, and he had a whole bunch of units behind his house. So, literally you walked into his house and he's got a white t-shirt with spaghetti stains on it coming out and saying, "What do you need?" it's come that's a generation ago of storage. And now, we're developing on the corner of Main and Main with 3-story stone and glass buildings. So when you walk into the retail office, it feels like a Starbucks. It's that type of feel. So, I think most people want to ensure that their stuff is safe, that it's clean, and that they have the customer service that they need. But there's not really a specific amenities. You mentioned the technology. There are some operators that are doing kiosks where there's no humans on the site, right? So that you can go in. It's like a vending machine. You can rent the unit. You can get your locks all electronically. And we've evaluated that, and I think there's probably opportunities in some markets for it. But for us, a big part of our revenue stream comes from ancillary income, typically 10 to 15% of pro forma. So things like U-Haul truck rentals and point of sale systems where we're selling box and locks and tape and those kinds of things, tenant insurance, those all require a human to interact with you. Because we call them effort sales, right? Like you have to ask, like, hey, you're renting a truck. Do you need boxes? Those kinds of things where if you do a kiosk, you're walking away from a portion of them. We don't have any, so I can't speak to our own data, but it's certainly something that right now doesn't make sense based on the portfolio we have.
Yeah, no, that makes sense. That makes good sense. So Kris, what are your thoughts? We're ticked over to a new decade here. You mentioned some consolidation. What other thoughts do you have on, what this decade is going to hold, and what are you guys doing at Reliant to scale in terms of that and take advantage of some of these trends?
I think the biggest thing in storage right now is the new supply that's hit the market, right? So in the short term, it's riding out the development cycle that's happened. I mean, in any asset class, if you perform, people are going to show up, right? So after 2007, 8, 9, 2012, people realized, wow, storage did very, very well. And you see, if you look at the amount of development spending in storage, talk about a hockey stick from 2014 to 2020, it's crazy. So the most new net rentable square footage in the history of the asset class has been delivered in 2018, and 2019 beat 2018. So,
wow.
With that comes a lot of new supply to market, and the short-term impact of that is it's going to impact some of your markets, right?
Sure.
It's based supply and demand. So I think the short term is we're going to have to ride that out, and there'll be some markets that are impacted. Primarily, that development was across the top 50 MSAs, right? So think New York, Dallas, LA, Denver, Atlanta. We primarily operate in secondary and tertiary markets, so that's where we've been able to find value and be competitive. So it hasn't affected us as much, but there's certainly been some markets that it's affected us for sure. So I think in the short term, Kris, you got to let that settle, and we'll kind of come back to an equilibrium. I don't foresee, and this is my own hypothesis, so take it for what you will. I don't foresee us having a major shift in the demand curve for storage. If you look at some of the population trends, here's what's most interesting to me on the long-term growth. So, if you look at the national REIT data, which is all public, you can go out and see their investor presentations. They track their portfolio scale, and some of these facilities or companies have thousands of properties across the United States. They look at the percentage of population that a specific generation makes up of the total U.S. population. So let's say, and I don't have the numbers in front of me, but let's say baby boomers make up 30% of the U.S. population, right? And then they compare that to what percentage of their tenant base that generation makes up, right? Mm-hmm. And what they're trying to see is it relatively close? Like, for example, the boomers are relatively close, right? They make up 30% of the U.S. population, and they make up 25% of their tenant base, right? So it's a pretty good indicator of like, okay, generation by generation, how's this going to work? The most recent generation, which I think is Generation Z, I'm not 100% on that either, but the youngest generation, storage users, the most time that they spend, or the best consumers of storage are between 30 and 65. Gen Z, 65, yeah. Makes sense. Right?
Yep.
They make up 35-ish, don't quote me on the exact numbers, but 35-ish of the percent of the US population, but they make up less than 5% of the storage consumer base. And so the hypothesis behind that is as they come of age, it makes the pie bigger. So you're going to have more people consuming storage, which obviously is a win for us. We hope that's the case. And as boomers start to die off and that percentage gets lower, they will outpace the boomer die off. So, it's interesting demographic trends that, only time is going to tell on that. But if you're asking me what's kind of my long-term view of it at the decade level, that's how I view it.
Yeah, that's terrific. So I guess how sticky is self-storage? So you said, the pie is going to grow. So if I'm 60 years old and I move my stuff into a unit, am I likely to move? How likely am I to stay in there or move out? Or, that's one of the things I enjoy about self-storage is, you raise prices $5 or $10 a month. I'm probably not going to move my stuff to another self-storage unit.
Yeah, I mean, it depends on the market, right? And the type of tenant that you are. Residential tenants have less tenure than commercial. Typically our commercial tenants are staying 24 months or more. Most, I think in our particular portfolio, we just looked at this a quarter ago. I want to say it was just under 40% of our tenants stay less than 12 months. And then it's another 40% that are staying more than 12 months. And then there's a 20% period of the tenant base that is essentially 12 months or more, or I'm sorry, I think it was 24 months or more. So it depends where you are and what markets you're in. If you're in a snowbird market, right, where you have people coming in and out every winter season, typically those people are stickier, right? Where I'm going to put all my summer furniture in storage and then I'm going to leave for the summer and go home and then come back in the wintertime. Those tenants hang around longer. If you're in a real transition, a lot of move-ins, a lot of move-outs, we have a property at a mixed-use development or planned use development in Florida where they're just buying and selling a ton of homes. And so we're seeing a lot of churn. We see a lot of volume, people moving in. We also see a lot of people moving out just as homes are finished and they don't have that need for storage. So it's really a market by market specific dynamic.
Yeah, cool. Thanks for sharing that.
So, Kris, one question we always ask on the show is if you could go back in time and talk to your 25-year-old self with everything you know now, but just offer yourself one piece of advice back then, what would it be?
Specific to storage, or are we talking about life?
Life.
You can pick.
Yeah.
Well, a couple things, I guess, and it's going to sound hokey because I've listened to a lot of podcasts and people probably have similar answers. I think the first one is from a real estate investing standpoint, you have to jump in, right? So at 25, I was still chasing money, I think is probably the best way to describe it, where I was looking for paychecks. And then when I started to make, what almost everyone would consider really great money, I was like, oh, that's not what I want. With real estate, it's for me, it was about controlling my time. That was kind of what I realized. And as I get older, realize is the only thing that matters. You can always make more money. You can always buy more stuff. But the time piece, doesn't matter how much money you have, you're not getting it back. So, for me, it was jump in sooner. I didn't know everything, but it's really hard to learn if you're sitting on the sidelines. I'm not saying, I'm not advocating for you to do dumb stuff. You got to educate yourself, but surround yourself with people who can mentor you and help. And that's what we did in kind of my path. I've had good partners along the way, but you got to jump in to learn. So I would say that, and then, that's specific for real estate. On the life piece, and this is something I still struggle with, but the fear part, there's so many quotes about fear, but it's one of those things that the person it's scariest to is you. Usually it doesn't turn out the way that you think. So, when you're laying in bed thinking, oh my God, what have I done? It usually turns out okay. So the fear piece is one that I continue, day to day. Like sometimes we're doing stuff here that I'm like, I don't know why we're doing this. This is going to turn out bad. I'm going to be living in a van under a bridge. So far, so good. We haven't ended up there yet. So I think those are two things that you can apply to almost anything.
That's terrific, Kris. And that's, again, that's one of the reasons we wanted to have you on. It's been super interesting learning a lot more about the self-storage industry. I know our audience is going to have some questions. What is the best way for them to learn more about Reliant and what you guys do?
Yeah, for sure. So if you're interested in kind of the operating company, we have a couple websites to check out. So Reliant, www.reliant-mgmt.com really talks about the storage platform. If you're interested on the passive investing side of things, Reliant Investments, plural. And so reliantinvestments.com that has a lot of information about our investment platform, track record. There's also some educational components on there, Kris, for new investors who are looking to kind of understand what they should know as they get involved. We've done a bunch of video series, it's all free just to limit the number of questions that we get as investors talk to us. So all that's on reliantinvestments.com. And then I'm pretty active on LinkedIn. You can certainly connect with me. Kris Benson, it's Kris with a K. But if you Google me and Reliant, you'll find us.
Terrific. No, thank you so much, Kris. We really appreciate you being on the show. You've done a terrific job in terms of putting out that educational material. We're going to have all of what you just mentioned in the show notes. So if you're listening, like Kris said, in the car, go ahead, take a look at the show notes. You can find more information on Kris Benson, Reliant, and learn more about the self-storage. Thank you so much for being on with us today, Kris.
My pleasure, guys. Have a good rest of the day.
You too.
Thanks. You too, buddy.